Art Collins here, talking to you from the bunker. Recently, I gave you a new way of looking at the relative strength weakness of a single day's price action. Let's review it. First of all, we're talking a daily bar, but day session only, 8:30 a.m. to 3:15 p.m. Central Time. And we're going to break the bar into three parts: the high to the open or the close, whichever is the highest, the close to the open, negative or positive, and finally the open or close down to the low. So to get a value on an up bar, we got to separate the up from the down bars. We determine areas that are making it stronger and areas that are making it weaker. And we start with the top here. We're going to go from the close to the high rather than the high to the close, because this is however high it went on the at the high of the day is ultimately a rejection relative to where it closes. So this part is negative. We take the close minus the high. Close minus open, of course, is always going to be positive. It's an up day. That's the meat of the day. No mystery there. And the open to the low is another rejection. So we're going to give that a positive value since the market did move away from that. Down bar weakness. The open minus the high. We're looking for negative values now. The open to the high would be a negative value because that move up to the high was ultimately a rejection. That went lower. Close to open is always going to be negative. And finally, the close to the low is always a positive number, and that's what we want to take away from the bar's weakness value, because, again, it's a rejection of the low point of the day, going higher into the close. That's what I gave you before. Now, today we're going to look at how you can get an idea of whether tomorrow is going to be up or down by comparing the number that we compute to the open to close. So we have to start on our day indicator by adding the three segments that we computed together, dividing by 3, comparing that number to the close minus the open value. If the indicator is greater than the close minus the open, that is a buy bias. Buy tomorrow on the open. If it's less than the close minus open value, sell short on tomorrow's open. And exit on the close. It's a little confusing, I guess, just hearing it, so let's do a visual. Daily bar, day session only. We compute this value. The close, 2401.50 minus the high, 2442, equals negative 40.5. Then we do the close minus open. That's 2401 again, minus 2353. Gives us a value of 48.50. And then finally, the open minus the low is again a strength indicator because it's a rejection of that direction. 2353 open minus 2262 low gives us 91. Add the three numbers together, we got 96. Divide it by 3, 32. And we compare that to the open to close value of 48.50. So that's negative. We should be a short seller the next day. How did that work out? Well, they can't all be gems, but this is a 10-year history of it in the S&P. 57,000 off of 2476 trades, roughly 50% accuracy. This figure tells you that this is not a system. This is just an indicator that you can maybe combine with other indicators if you're looking to forecast probable direction for tomorrow. $23 average trade before slippage commission. This is what it looks like in all 5 of the markets. Again, this is from early 2010, beginning of 2010, through the 20th of 2020. Again, just simply an indicator. It's not nothing. Not good enough to trade, but good enough to do a little research on yourself. And I will continue to do so and share whatever I find with you. Check that out. And that's it. Until next time.